Today we will learn how to optimize a trading strategy in order to get superior returns. This is part of a series of videos where we started with a random trading strategy where we took trades randomly, and then brick by brick we started adding building blocks in order to make this strategy better. In our first building block, we introduced the simple moving average indicator in order to take trades only during the uptrend of the stock. And now we are adding one more building block where we are optimizing the parameters of the simple moving average strategy. We will show you how this affects the returns. When we did a random strategy on a large time frame, we observed that our returns were really bad, which was also like they were negative, and they were even worse than the buy and hold returns. And then we applied the SMA strategy in order to get our returns to much better than buy and hold, minus 1.3%, but still a negative return. And then we were able to optimize this strategy, and within like 50 optimization steps, we were able to reach a return of 1.24% or 1.2%, which is a positive return and way above the buy and hold return, almost 9% more than the buy and hold return. So let's step back a little bit and talk about our series of steps that we took. So I will link to the previous videos below, and also I will link to this notebook in description so that you can learn how to build an optimizer. But we started with a random strategy where we took trades randomly. We would enter a trade in the green line here, and then we would exit the trade in this red green circle and the red circle here. And sometimes we would win, sometimes we would lose with a random trade, and the losses are marked with this cross here. So this is a case where we would lose a trade. Sorry about that. Okay, so that was our random strategy. And as you can see, the problem with that strategy was that we lost a lot of trades in the time when the stock was sort of trending down. Now, we tried to alleviate this problem by introducing the simple moving average indicator. Again, we are doing extremely simple things to try and slowly build the strategy up brick by brick. By doing that, we observed that we were able to eliminate some of these trades when the stock was trending down. But that wasn't enough, as I showed you in the returns. There was a small increase in the win rate from compared to the random strategy. So the random strategy gave us a win rate of 66%, whereas this gave us a really small increase in win rate. When we tested out this strategy on a large time frame of about 5,000 data points, we were able to see that compared to the random strategy, it did extremely well, but the returns were still negative. So what do we do from there? So we built an optimizer, which is the topic of this particular video, and I will teach you how to build an optimizer so that you can optimize your trading strategies as well. So now, in order to do that, let's sort of start from the beginning and give a little bit of a background on the strategy and sort of the code for the strategy. So our data is 5-minute time frame Bitcoin data, which we use in a lot of our videos. And then we have this backtesting library, which I described in a previous video, which I will link below in the description. And in the backtesting library, we can define a strategy where we define this random strategy here. And what this random strategy does is, let's see. Yeah, so the only thing that you need to care about in the strategy is this run function and our entry sort of signal. The entry signal for the random strategy simply says whether a random variable is 0 or 1. And then we get a random number. If the random number is 1, we buy. And then we sell if we reach a take profit or a stop loss. And we define the profit and the stop loss percentage. And then we modified the strategy in a previous video where we modified the entry signal by saying if the random number is 1 and the current candle's high is above the simple moving average. So that was our modified strategy. So now we want to build an optimizer. So if you look at this strategy here, you will notice that the only parameter, so there are 3 parameters in the strategy. One is the profit and the stop loss percentage, which we define when we define the strategy here. And then there is the SMA, which we separately calculate. And then the SMA has a time period, like how many data points do I take to calculate the simple moving average. So in our case, when we define our strategy based on moving average, we define the simple moving average as the rolling mean of 100 data points. And this is another sort of parameter in our strategy. So what we do is define an optimization function. So to define and optimize the strategy, we define an optimization function. And the optimization function basically takes all of the possible sort of arguments, all the possible values that I can give to these variables, and then it returns like what the quantity that we're trying to optimize, in this case a percentage return. So we define a particular sort of 2000 data point, the first 2000 data points, we calculate the rolling mean or the simple moving average using the SMA value that is defined here. And then we define our random SMA strategy with the profit and the stop loss percentage. And then finally, we run the backtest and return the percentage return. And this is an example we show here with our optimization function, where we use, the usual the stop loss and then an SMA value of 100, and it gives us back this number, which is the percentage return if we use these particular values. Then we define a dictionary of parameters. So the profit percentage is the take profit, which we define from 0.0 like 0.5% to 5%. Similarly, the stop loss we define as 0.5% to 5%, and the SMA value we define from 50 to 250. And then we define an optimum, the optimization strategy as random. This is something that I will describe in more detail. And then we run 50 runs of this strategy. And then we obtain the best parameters. So we get an SMA value of 200, stop loss percentage of 1%, the profit take profit of 1%, and a stop loss of 0.5%. And with those values, I am going to test a different data set, which is really important. So I did my optimization on the training set, which was the 0 to 2000, but I'm testing this on a different data, which is from 2000 to 7000. So this is the future data that the optimizer does not have any idea about. So this is my test set on which I test it out. And as you can see, my returns are superior to what I would have obtained without doing the optimization. So now let's talk about the optimizer itself. So we use a random search as opposed to a grid search. So we defined this grid of parameters, as you can, let me see. Let me go back here. Yeah, so we defined this grid of parameters on the profit, stop loss, and the SMA value. If we want to search through all of these, that would be exponential. So I have maybe 1, 2, 3, 4, 5, 6. So like 6 multiplied by 6 multiplied by 6, that would be a lot of numbers. So maybe like 36. So 36 multiplied by 6. So like 240-ish. But we really don't want to test out all of those strategies. So if you look at previous research on hyperparameter optimization, this is from 2012 from Ishua Bengio, suggests that random search with the same computational budget finds better models by searching a larger, less promising configuration space. So this is a very good figure actually from that paper, which shows that the grid search basically searches every point in the grid. So in this case, in our case, a three-dimensional grid, but instead of doing that, we could sort of pick out random points in the grid and search, and with the same number of data points, this will yield a better result, which is exactly what we do in our code here. So in our sort of strategy, first of all, we need to define the full grid, which we use this itertools.product, which is a very handy function to sort of take a dictionary and then create this list with each parameter as create a list of dictionaries where each dictionary contains a value from each of these dictionaries of lists. So it converts a dictionary of lists to a list of dictionaries. And so we define this optimizer and we ask whether to use the grid or the random search, and we define, we use the random search in our case here. And so we define this function, which is the optimization function that we're going to run. We define all of these params, and then the expand parameters basically does, this operation here using itertools.product, which converts everything to a list of dictionaries. With that list of dictionaries, if the search strategy is random, we just randomly sample 50 values, which is our number of runs from the whole complete grid. And then we're trying to maximize, so first define the best value as minus infinity, and then we just run through our grid, which is sort of now a random sample of the grid, and then we take each result, and then if result is better than the best value, we get that as the best parameter, and finally return the best parameter. So this is what the optimizer does behind the hood. And the idea is that we can take any trading strategy and use this optimizer to find the best set of configurations. And the only important thing to understand is that the set of the data that you optimize over shouldn't be used to test this strategy. So as you can see here, we have a separate sort of training and test data. So thank you for listening to this video. And basically, I think the takeaway from this video is that we can use this optimizer to optimize any trading strategy to give us superior returns. I'd love to get any comments or feedback you have. If you use the optimizer, as always, the download link would be in the video, and same with my previous notebooks. So please like and subscribe if you like what you see here, and I will continue to talk about more trading strategies using Python. Thank you.